Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm joined today by our global market specialists, John Briggs, Giles Gales, and Theo Chapsalis. Before getting into our discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to all our latest episodes as soon as they're available. And I reminded you all last week, but just another reminder that we're very open to answering questions from our listeners on the pod. You just need to email us at bondcast@natwest.com or get in touch directly if you have any of our contact details. All right, Bondcasters, so another important week with big central bank meetings. So let's kick straight off with the Fed. It's Thursday when we're recording this, so we had the Fed last night for UK listeners, and I would say that they surprised on the hawkish side, but as we were kind of leading up to the meeting, it was sort of well flagged, by us, by you, not by me, that the risk was certainly to the hawkish side, and they met those kind of hawkish risks, I would say. I guess the shift to the dot plot, the kind of admission from Powell that this was the meeting that they were talking about tapering, and big jumps in the near-term inflation forecast, although not in the longer-term inflation forecast, were perhaps the main takeaways. But John, what are your kind of key takeaways from the Fed?
Yeah, I mean, as you said, we've been looking for a hawkish response or hawkish risk to this meeting, although I will say that they went a little bit further than even we were thinking. We have the dots, as you said, they've signaled 2 hikes in 23. We were along with consensus on 1 hike for 23, but thought there was potential for upside risks, even if it was possible, even not probable. But I think in addition just to that signaling, Powell did talk about kind of keeping this as a transitory inflation pop that we're seeing now. But more importantly for me, and we've talked about this in some past podcasts, is that he basically formalized through the press conference the idea of a balanced risks outlook. We had talked about how Clarida signaled this before. Brainerd used a balanced risk approach. And even Quarles, who tended not to make policy speeches, more of the regulatory guy, he had signaled as well. So, it was clear that there was kind of a unified message around that. But him solidifying that via the FOMC press conference was important. And, again, this is just the idea that for a while it was all about unemployment and getting unemployment down, and getting, the breadth of economic growth to all areas of the demographics in the country. But, with the inflation picking up, they're definitely solidifying that other side and basically saying, yes, well, reminder, the inflation mandate is just as important. But was in addition to just recognizing that these transitory pressures could last longer, or that, the supply side shocks, I'm kind of reading through here a bit too, but the supply side shocks could cause inflation to stay higher, and they want to keep the credibility on their inflation mandate. He flagged uncertainty around the inflation outlook. And I think that's important because when we think about some of our views, which have been that the market needs to price in a higher probability of future rate hikes, that, belly should weaken, the 5/10 flatteners, all that kind of stuff. If the Fed is admitting, and I think we all know that this is a very uncertain time, but even if the Fed is uncertain about the potential for future inflation outcomes, basically, if you think about it as a fan chart, you're really widening that fan chart, and this with an upside skew. So if that's the case, you can kind of take that same approach to the monetary policy rate outlook, where if you have an increased uncertainty at a time where inflation pressures are high, again, it may be marginal. We're not talking about massive rate hikes anytime soon. It's a drawn out process, but your probability band for future rate hikes is now, wider and skewed to the upside. So I do think that some of these recent moves can continue. One last point, and then I'll take a break here, but is that, it is a little bit uncertain. The one where I'm uncertain is we've had this move higher in yields. We've seen, the curves flatten like we've looked for. We've seen the belly weaken. But the next event is really that next CPI report, and market reaction function to inflation data is going to be higher. But, do investors come in and say, well, that's okay, I got 3 weeks worth of carry and yields are higher, so it's more of a range trade, or does this trend extends? I have more faith that over the next couple of months, we're going to see 5-year yields go over 1% and that kind of thing. But, I could see a little bit of money being put to work here and just more of a sideways trade, but we're not changing any of our biases.
Okay, well, definitely that kind of weakness in the 5-year point worked well yesterday and is still working well today as well. The 10 years leading that retracement back down again. So 5s, 10s is continuing to flatten. I guess if we look forward a little bit then, well, sort of forward to the near term and then forward even beyond that, how are you thinking about the Fed from here? They surprised, on the hawkish side. This meeting was the meeting where they said they were talking about tapering. You'd previously thought that they might formalize some of that discussion around tapering kind of September time to set them up for tapering to begin perhaps Q1 of next year. And so that's the kind of near-term policy action, I suppose, and then much further down the line, and of course a lot can happen between now and then, but we, I think, had the first hike in for 2024, which is now further out than what the dot plots are suggesting. Are we thinking about updating our view on that, or are we comfortable with the tapering timeline in the near term? And obviously there's a lot of moving parts beyond that mean that we're not in a rush to change that particularly.
Yeah, I mean, I'm still comfortable with the tapering timeline, that I think that they've certainly talked, this is we're talking about it. I think that the minutes the minutes of this meeting will be very interesting because just what's the breadth of that taper. But I still think kind of a September, we're looking to at some point to reduce accommodation if, further progress is made against our goals. And then December, they announced it for Q1. I've always been in the framework that they could do a faster taper. Like some people were saying a 9 or 12-month taper. I've always been in that 6-month taper. But again, I'm a little bit more aggressive because our inflation forecasts are more aggressive. So for them to, at the end of the year, we've got CPI between 3.5 and 3.8. And I look at, to sit there and say that, okay, well, it's going to take us a year to get to taper just doesn't feel like the right outcome if I'm just thinking forward. On the rate hike side, yeah, I mean, we've been more focused on just the idea that over the next 6 months, call it, the market needs to price in more, even if we don't think that necessarily that pricing, by the time you get there 2 years from now, will be validated. I think the economics group and strategy group is going to put our heads together as far as whether that's going to revise that forward. I still think the main focus is on kind of just the next few months, what the market moves are going to be. If we move to having some hikes in late 23 versus early 24. I mean, it's kind of far away in semantics, but it is important. I think that clearly the rest of it to be moving that forward.
Okay, all right, John. Well, I'm going to come back to you because, like I say, we've been getting questions from the listeners, and this week the question I've chosen you are the lucky recipient of. But I just want to, I want to stick with the theme of central banks, or more specifically the Fed, and just pass over to you, Theo, to hear about the reaction in the US linker market to yesterday's FOMC.
Yeah, I think yesterday's meeting was particularly important for the TIPS market. So the TIPS market over the last 1 year has been supported by, that patience argument and that the Fed is really happy to allow inflation overshoot. So this brought to the market additional buyers. We talk about non-specialist investors. We talk about investors that wanted to obtain an additional view, an additional exposure to TIPS. We did see flows into TIPS ETFs, for example. So a lot of money that was not in TIPS got invested, and it did also well, and it got validated because of the prints. So when you consider both the April and the May print, they were unambiguously strong. But right now, we have a bit of a different setup. And yesterday's price action, the 20 basis point sell-off that we saw in 5-year TIPS, this is both remarkable and scary. Now, we know that in the TIPS market, once the word tapering is being mentioned, that this causes fear. It brings back memories of 2013. And we know that if tapering is to happen, then we talk about real rate sell-off predominantly. So call it, a 530s real rate flattener. So TIPS actually do exaggerate any move that you would get even in conventional rate because of that shift in monetary policy. So what does it mean for us and what does it mean for the market going forward? Well, definitely we do expect more challenges for the TIPS market. We think that valuations are quite expensive. They start from a high level. So we think that to the extent that tapering becomes a possibility, rather than a remote scenario in the future that more and more pressure should weigh on tips. So this is not really the very front end of the curve. And if we talk about 1 or 2 year tips, these can still very much be in demand. When you look at energy, for example, energy has not suffered anything. I mean, if you look at the price action, it has been very stable. And if you are looking at the very front end of the curve, that yes, that can be still supported because the hikes don't take place. But then if we talk about potentially a faster tightening path and tapering, then, well, real rates have a lot of scope to correct. Hence, I think that the 5 year segment, for example, the tips curve is particularly vulnerable to further cheapening, let alone also the auction that we have today.
I probably should have said this before I let you answer that question, but when we talk about tips, we're talking about US inflation-linked bonds for any listeners that didn't know that acronym. Okay, so sticking with inflation then, because the other, I guess, big event this week in the UK market, at least, was we had the May inflation print. So it was kind of an interesting print because CPI surprised to the upside, but the market was, or definitely took its lead from the RPI print, which surprised to the downside. I know we all know you have talked a lot about UK inflation and what this means for the front end, but could you just update us on how you're thinking about the front end of the UK linker market and how that looks into a summer of carry or not potentially?
Yeah, absolutely. I think in the UK market, the carry trade is usually the short inflation trade because, well, inflation does trade expensive. So when it comes to that very print, so we talk about the May RPI print, it came 20 basis points lower than what it was priced in the market. So this is significant. At some point, it was trading even 30 basis points lower. Sorry, it was trading 30 basis points higher relative to what we realized. So clearly there was a significant undershoot. Clearly we see a rush from technical investors to get out of of some of those inflation positions because, well, things look actually very expensive now. I think that we have supply next week, other than the Bank of England meeting. So we have supply, we have this will be something that the market will have to take down. We talk about ultra long linker supply. We talk about 5.5 million basis points. This is a big number for the UK linker market. So long story short, with a weaker number in RPI and more issuance coming in and an environment which is not supportive for further inflation link, mostly in the US, but also in the UK. So we are happy to be short. And we are short 15-year break-evens because this part of the curve, look particularly expensive. But in general, the view is to be short breaks. And what we see now on days like today, it is really that real rate-led move, which is not very common. So usually break-evens move in line with rates, and usually higher rates means also higher break-evens. But yes, you can have situations of higher rates and lower break-evens, which is what I think we're likely to witness in the near future. And it is, to me, this is very interesting. Well, we need to keep an eye also on what we get from the BOE meeting next week.
Well, you've led me very nicely into my next question there, Dan, because like you say, we have the Bank of England next week. That rounds off our kind of trio of ECB, Fed, and then Bank of England meetings over the past few weeks. So perhaps you could just tell us what we're expecting from the Bank of England.
Well, I don't know whether there will be any fireworks. So we've got a lot of excitement in the US and the Euro area. The UK, I think it will be fairly boring. And if it is boring, it means also something because there are a lot of tactical players that have paid the front of the curve. So we feel that the short position at the front end is particularly crowded. So we do expect an upbeat BOE. Clearly, they need to acknowledge that CPI has been stronger, as you've mentioned. The labor market looks healthy, and we talk about growth data that are fairly okay. But the question is, do you get an additional strong hawkish commitment? And this is where we push back. And this is the important part because Ross Walker and I, when we look at the market, and Ross is of the conviction that hikes will happen in 2023, but we have a market in the UK where hikes are priced in as early as 2022. We have a full hike being priced in by August 2022. So there is a clear asymmetry. And to us, there are high expectations in terms of rates and in terms of a clear hawkish signaling, but we don't think we're going to get this signaling as of now. So it is really about acknowledging the strength of the market, but and of the UK economy, but not necessarily delivering something more hawkish. And hence we think that very front-end rates can actually rally given the current setup. So yes, we do have a steepening bias. We are underweight the back end of the curve and overweight the very front end.
Okay, great. Well, we will be recording this podcast after the Bank of England next week, so I'm sure that will be a key topic of discussion, and we'll be able to have the luxury of knowing what they actually did by then. So over to Europe then, Giles, because Europe has moved a fair amount over the last 2 days in reaction to the Fed. And, we often think about global central banks kind of moving in unison, and in a lot of ways, the Fed kind of leading that charge. Does a slightly more hawkish than expected Fed kind of give the green light to the ECB to be more hawkish than they perhaps were last week, do you think? And is that what the market is now pricing in, overnight and today?
Okay, so I would say no, not really. I think that the ECB has shown that it can do something completely different to other central banks for years on end, and I think that that's probably one of the things that's really been pushing yields down as people move into the summer. We're now mid-June, and I think that just people can see this sort of long stretch of summer ahead of them and thinking, oh my God, there's no proper trigger for anything until the end of that at the earliest. And so I think that really what we've seen is people squaring up, maybe even just putting on some new carry trades as well. And I think that probably makes a fair amount of sense. I suppose we'll get onto it, but I think that September is absolutely stuffed full of interesting risk events that will mix things up as we progress into the summer, though. I'll just say, before we get onto those topics, though, I mean, the reaction just to the Fed, I think it makes sense in the sense that there's a cross-border element here which matters. We've been talking about this as one of the key themes really for European fixed income for more than a year now. And so I think that higher rates, or the prospect of higher rates in the US, certainly has a kind of magnetic attraction sort of effect on European rates as well. So it's right for that to be factored in. And the other is, of course, that yes, absolutely. If you're thinking, right, what's my sort of mental probability of something to react to for my central bank in September or some point in Q4? Well, getting that confirmation from the Fed that you probably have the taper discussion and maybe an announcement, December or something like that, I think encourages you in that conviction.
Okay, so going back to what you were saying about summer, because I think I have two sort of discussion points or questions that are relevant to that. And the first is really, I guess, then what are you thinking about flows into the summer? We got confirmation last week that the ECB is still going to be buying significantly more over the summer. Is this the moment to kind of step back and say, okay, we're not going to fight the ECB for the next few weeks? It's, the ECB will be buying more than the supply that we'll be getting. The ECB is in vol control mode, like you said. Is this the kind of green light for carry trades, for bond yields not to be significantly higher from here? And I guess the second part of that question, which you also touched on, is around this idea that the ECB is in vol control mode, but this summer's going to be low volatility anyway. There's no risk events, and summer's always quiet. Is that the right assessment, or do these kind of lots of big events which we can go through, they're global, it's not just Europe? Does that mean that actually summer might not be as quiet as we think?
Right. Okay. Yeah. So, to tackle those in turn, I mean, the first thing to say is that yes, we have been back through all our supply assumptions, and part of this, when we say supply, we also mean the ECB's purchases, because that's in a sense negative supply, and so I mean, you have these two huge flows going on. You've got the primary market, and you've got almost all of that. In fact, a little bit more than that being sucked back out by the ECB. And so, a basic question that we always come back to is how much is left for everyone else, and how likely are they to feel enthusiastic about selling or whatever to sort of fill that gap. And I'd say that we've been, I've personally been through a little bit of a roller coaster over the last couple of days, and I'm very pleased, and I'm sure that all our Bondcast listeners will also be very pleased to hear that we've come to a bearish conclusion. So hooray! It wasn't obvious. It wasn't obvious at all. I mean, as you say, Imogen, we do have negative net supply, and that has been going on already for the first half of the year. What we and will continue over the second part of the year. We had at the 6 months ago, we thought that actually things might be a little bit freer on the supply side. It looks like we've had to revise down our assumptions on the corporate side. We've had to revise up our assumptions on what the ECB is doing. Net result, we've probably got a shortfall of about 100 billion euros or something like that for the rest of this year. And that sounds like a lot of money, but once you start looking at what people actually hold in the other major sectors, I mean, you can fill that pretty quickly. So the real question is, how are people really going to feel about things going into the summer? And we've done a bit of seasonal analysis, and it seems like the major players are typically a little bit quieter. And so, I think at this stage, I think it's right not to really want to aggressively fight the flows, if you'll allow me. But we, putting everything into the mix, do come out bearish on this. And I think that going into August, to come to the second part of the discussion or of your questions, I think that the focus from there on some of these risk events will skew us more towards a higher bearish conviction from there.
Well, I'm very happy to hear, and I'm sure Bondcast listeners will also be happy to hear that you're back to being bearish. It was a little bit worrying last week when you said that you had very low conviction in that, so I'm very pleased. And just to kind of round off that discussion, I guess, the risk events that we're talking about as we get into the end of the summer, for anyone that is wondering if they've missed anything off their list, we're kind of thinking about Jackson Hole at the end of August. We then have this September ECB meeting on the 9th. US inflation, I think, is the middle of the month on the 13th. We've then got the Fed meeting. We've then got German elections. We've then got Sintra at the end of the month, when we expect or think maybe they might present the strategic review. So there really is a lot going on, starting from, I guess, Jackson Hole at the end of August and into September, that will make it a very busy month. Now, John, I said I would come back to you with our listener questions. So just a reminder to anyone listening, if you'd like to ask us anything or send me ideas of questions that I can pitch to our Bondcasters, please do email us at bondcast@natwest.com. Now, John, we've talked a lot over the past few weeks about monetary policy and inflation. We've done the theme a bit to death, I would say. Not to say it's not relevant. Obviously, that's what's driving markets at the moment. But something we haven't discussed as much in detail is fiscal policy in the US. So perhaps you can just update us where we are with that and what's the latest kind of stage of the debate right now.
Yeah, so we've had a breakdown of the negotiations by Senator Capito on the GOP side and Biden's team, but it has not signaled the end of bipartisan negotiations. So it's moved on to like this group of bipartisan so this group of senators led by Kristen Sinema, who's a Democrat from Arizona, and Rob Portman, who's the Republican from Ohio, that are trying to come together with another bipartisan plan. Now, as of now, there's actually two plans they're looking at, which is it's about $1 trillion over 5 years or 1.2 over 8. Again, that's below where Biden's been. And if you look at it in new spending, it's around $600 billion, again, below kind of what Biden's wanted to spend. However, there does seem to be good faith efforts here to try to come up with, negotiate a bipartisan plan. The sticking point's always going to be on the pay for it. What kind of tax increases are there going to be? Is it going to be, I think these proposals have a lot of repurposing unused COVID funds, shifting stuff around, tax evasion markups, chasing tax loopholes, like things that, you can tell I could be a little skeptical about some of those actual revenue raisers. But in any case, that, they put another soft deadline on that for probably a couple of weeks from now. I think definitely, past the July 4th holiday, if this fails, the pressure for Democrats are going to move on. And one of the reasons why I think they do want to keep doing bipartisan negotiations is that Senator Manchin has wanted to have a bipartisan deal. But if they've gone through 2 months of good faith efforts and still can't get a deal, he's more likely to vote for a Democratic only package, because there will at least, he can say, look, we tried for 2 months. We tried 2 different iterations of it. We just couldn't come to an agreement. We need to do something to improve our infrastructure. If they go alone, Biden had initially proposed a $4 trillion plan that includes a lot of social issues. And just today, Politico reported that there's a $6 trillion plan out there that Schumer's working on. The thing is, again, you got to come back to, will the moderate Democrats accept these kind of numbers or not? So even if bipartisan negotiations break down, I don't think the market should start saying, oh my God, we're going to get $6 trillion in spending. We got to be cautious about that. I still am kind of in that ballpark of where we were 3 months ago, that in September we'll get like 2.25. Maybe it's half paid for by taxes, likely to be Democratic only, but there is a decent, I'm kind of more optimistic than most of the team, probably maybe a 1 in 3 chance that there is a bipartisan deal. And then Democrats do their other priorities, try to get another bill going later in the year.
So in terms of markets, I guess the key takeaway is that the risks are skewed to the upside on the number, and that supports
but the timing's tricky, right? I mean, because and also there's a couple, evolutions here. If they get a bipartisan deal, let's call it $1 trillion, you can say, all right, well, then it's going to be, that's lower than expected. However, we've got another deal coming up. Some people will say, well, you got the easy stuff done. The next stuff's gonna be really hard. So even if you add another $3 trillion and Democrats are gonna try it on their own, it's gonna be hard to get through because they still got to get all the Democrats on board. So that could even run into next year. But if you don't get anything bipartisanship, you actually may have an argument that it could be bigger because now you have to get everybody on board because you've done nothing. So it's a weird kind of outcome-based thing. So I think one main point is that either way, this is not sending $1,200 checks to people's pockets in 2 weeks. This is, 10-year, or 5 to 10 year drawn out spending. They'll try to get things moved forward, but building a bridge doesn't take 3 weeks like it takes to go spend a stimulus check. So the reaction function compared to the last bills should be less, depending on the size, of course.
Okay, sounds like we could have done a whole pod just on that. And perhaps we will further down the line. All right, thanks guys. I think that's really all we've got time for today. But just to remind our listeners, if you liked today's episode, please hit the like button to show your appreciation and click subscribe so you can listen to our latest episodes as soon as they're available. And for one last reminder, if you want to send in any questions, please just reach out to us at bondcast@natwest.com. Thanks again. See you next week.